Today, my guest is Lee Fjord. Lee is a multifamily real estate property manager, a syndicator, a real estate investor, and he's based in the Arch City, St. Louis, Missouri. And in just a minute, we're going to speak with Lee about finding value add deals in your local market. But first, a quick reminder, if you like the show, CREPN Radio, please let us know. You can like, you can share, subscribe, and as always, leave a comment. We love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, and you can find us at Commercial Real Estate Pro Network. With that, I want to welcome my guest, Lee. Welcome to CREPN Radio.
Awesome. Thank you, Darren. How's your day going?
Hey, it's great. I'm delighted that you and I are able to connect and do this today. We've talked a little bit here recently, and I think this will be valuable for the listeners and the viewers. But before we get into this, if you could just take a minute and share a little bit about your background.
Absolutely. So I started in 2012 as a residential property manager, leasing agent down in Florida. Built a property management division of a real estate brokerage from 20 doors to 220 doors in 4 years, while simultaneously selling about $5 million a year in real estate down there. Got inspired by some of my clients and decided to pursue investing. Relocated to St. Louis, Missouri, where I have family, and felt like it was a great city to be able to invest in, specifically in multifamily, which is my primary focus. So moved to St. Louis, signed up with a property management company here to learn the market, dabbled in duplexes and houses and four families for about 18 months while doing that. Then linked up with my now partner, and we in October closed a 38 unit apartment building. And I decided at that point it was time for me to step away from managing other people's properties and helping other people purchase their properties and focus my primary energy on adding to our portfolio. Since then, we have put under contract a 42 unit apartment building, and we're working on the due diligence aspects on another over 240 units in total. And we're in the middle of a heavy value add, heavy lift on that 38 unit that we just closed back in October.
Well, for a guy that sounded like you were just about out of work there when you said you were going to stop doing the property management, sounds like you filled your plate. That's pretty full.
You know, overseeing the heavy lift is probably 50% of my time over at the 38 unit. You know, when you're taking down a value add deal and you're focusing on turning over the units, and increasing the value of the property, improving the property as a whole, it takes a lot of time if you're really hands-on, and that's what my role is in my team. Is I'm the hands-on, boots on the ground guy that makes it happen.
Got it. All right. Well, let's jump into this and talk a little bit about. Let's talk about the market, and then let's talk about your local market. You mentioned you had experience in Florida, and I'm wondering if you can kind of step back, maybe kind of a 30,000 foot view. Give us what you see is the current overall market, and again, that's kind of a more of what am I trying to say, a media personified deal as opposed to a local market, but just as a kind of a glimpse into what you see as the market, and then we can dive deep into local markets.
Yeah. So the commercial multifamily investing market is really competitive right now. I think that's changed for a number of reasons, and I don't necessarily think it's just based on the overall economy. I truly believe that, 10 years, 20 years ago, 30 years ago, 40 years ago, 50 years ago, people were still doing exactly what we're doing today, buying properties, moving tenants in, increasing the value, so on and so forth. It was kind of a good old boys network, or something that was behind the curtains that people didn't really know about. And they were, in a given MSA, you probably had a dozen wealthy families that owned the majority of their real estate in a given market. And now with you know, the expansion of the internet and the ability for people to do business, not just nationwide, but worldwide, the ability to be on a Zoom call or a video chat with someone and be able to have a conversation about it across the country changed the game. Now investors who are in other states and other locations, they can readily invest in deals across the country, and people around the world can now more easily or readily invest in properties where they never would have been able to 10 or 15 years ago. People from China and Brazil and the UK and places where costs are just so high and money is readily available, and it's a great shelter for their money here in the United States and buying commercial real estate, it makes sense for them. So that, in addition to the guys from New York and Florida and California, can invest in a property anywhere they want. That makes the competition pretty stiff. And that's what I think has led to that. And I don't think that's changing anytime soon.
No, I think you're right. The disruption of the economy in all segments, it continues, and it brings the world closer. I mean, just like you were saying, you've got people. I mean, just like this, you and I are on a Zoom call. I'm in Portland, Oregon. You're in St. Louis, Missouri. Not exactly, uh, you know, in the same room, and just the cost of not just the fact that the technology exists, but that the cost. This is, other than our time, uh, this is a free call, and it really is kind of mind blowing when you think about it. Let's talk a little bit about what you, as an investor, as a syndicator, and when you're talking with um, these potential investors from afar, what are some of the things that you look for? And maybe we can start with like a market. Describe what a healthy market is, and then maybe we can dive into St. Louis and talk about what's going on there.
Yeah. So there's dozens of ways to evaluate individual markets. And then, it's kind of in a triangle shape where you have the overall MSA, which can be, a couple million people and across many different counties and many different areas. And then you have, a city or a suburb. And then you have a neighborhood. And then you have a specific section of a specific neighborhood that might have the absolute best opportunities. And since I'm here every day, I'm experienced in the market, I can identify those individual um, sections of individual neighborhoods within a county or a city that is overall improving in a larger MSA that might be a little, overlooked or underrecognized. St. Louis has a population, the MSA, of 2.8 million people. The average job growth is about 1%. Population growth is about 1%. And that's not breaking any records if you compare it to, markets like Atlanta, Orlando, Dallas, so on and so forth. Jacksonville, you can keep naming them in there. You've got great amounts of population growth in those areas. And St. Louis doesn't necessarily have that from a large MSA, but we do have a great amount of job changeovers. Jobs are changing here in St. Louis, so we may only increase the number of jobs by 1%, but we're losing tens of thousands of jobs in areas like manufacturing, and we're replacing those jobs with biotech employee jobs, medical employee jobs, tech company jobs. We have a large growing tech business here in St. Louis, and those jobs are much higher paying than than your car part manufacturing factory worker. That those jobs are going away, and now we're bringing in jobs like biotech, and those guys are making six figures plus.
Got it. So the transformation, while it's not like just a mass movement to St. Louis, but like you're describing, it's just the kind of the economy within St. Louis. It sounds like it's changing from a more of a like a blue collar labor, the manufacturing jobs, as opposed to some of these more white collar tech um, jobs. Do you feel like the numbers are one for one, or
It's a
is
little bit
there?
high, so we are growing by 1%. So it is growth in the number of
Mhm.
population and growth in the number of jobs. In addition to those jobs changing over from lower income paying jobs to higher income paying jobs. And then you look at the demographic of the people that are the new higher earners, and you look at where they're choosing to live. And now I'm seeing a large increase in population in the South City and inner city of St. Louis, where it was, 10, 20 years ago was a much poorer area of town. And now those areas are now being populated by millennials and, younger families that want to live in the city, that want to walk out their front door and go 3 blocks over to the local coffee shop or local yoga studio. um, and they have a higher income, so they're able to afford higher rents, and that overall increases the intrinsic value of the properties that I choose to invest in those neighborhoods as the rents grow.
Right. So are you seeing like pockets that are gentrifying that are, changing from, previously abandoned, possibly crime, to new investment and the place to be, or?
Absolutely. In several different areas throughout the city, you're seeing a lot of, gentrification, a lot of cleaning out of the old and bringing in of the new. Lots of dumpsters everywhere, cleaning out these places, and homes that you never would have thought would have been opportunities for, let's say a flipper to come in and buy it and turn it into a $250,000 house. These are properties that 10, 15 years ago were worth, $50,000. And now, they're selling for 250, $350,000 all day to young, newer residents in those neighborhoods. And then, my strategy is to not only be looking in those neighborhoods that are already gentrifying, but look at the neighborhoods next door or within a short distance away, because you have displacement of the current tenants in those already improved areas moving to the neighborhood next door. So I buy in the neighborhood next door that still hasn't quite improved that well. And then I see a large influx of the tenants that are moving from two neighborhoods over or one neighborhood over. And then I provide a nice, clean, safe, affordable housing option for someone that can afford, six, seven, $800 a month in rent. And the previous rent might have been as low as $400 when I purchased that property per door.
What are you seeing now? If 400 was the prior rent, what are you seeing as far as a rent bump and something like that?
On my reposition that I'm doing right now, the average rent was approximately 400. We had some in like the, low 500 range of units that were slightly improved in the property. So when we bought it, the average rent across the board was 425, and we're now reletting the units that we have gone in and improved. Paint, cabinets, flooring, window coverings, light fixtures, plumbing fixtures, all the above. And we are reletting those $400 a month rental units for now $580 per month. So about a 40% increase in rent by simply investing, less than $4,000 per door. So $180 additional rent income per month per unit. or $2,200 per year for an investment of approximately $3,500 per door. So we're getting that money back in less than 2 years.
No, that works. And I'm assuming if the movement is afoot, and there's it's attractive. The neighborhood's attracting more renters, higher quality renters. I'm assuming, are you seeing a rent cap compression as well?
You do. You see that cap rate compression in the neighborhood as it transitions from, a D plus neighborhood to a C plus neighborhood. The cap rate will go from an average of, 8% at purchase. We bought it as a value add, so we paid 7.5% cap rate, and it was like 10% cash on cash return at purchase. And then we believe that at appraisal that we will be able, or within the next year or two, we'll have a neighborhood and have some comparables in the neighborhood and the sixes. So we will see not only increase in overall net income from rent increases, we'll also see some cap rate compression in that specific neighborhood.
Well, that works. Definitely, definitely better than the reverse. Buy the 6 and sell the 8.
Yeah.
Yeah, that's good. So I wonder, if you can talk a little bit about, being the boots on the ground as opposed to someone that's looking at the lagging online information, whether it be a census, because honestly, the not being familiar with the market, you may not have as granular of a picture of something, and there may be a distorted view of an MSA, or of what's really happening. Can you talk a little bit about the what you're able to see, and the opportunities that maybe you could get in front of that others from afar would not?
Of course. So, when you look at the statistics, population growth, job growth, when you look at crime statistics in St. Louis, I can really only speak to St. Louis, but it's a broad spectrum for certain areas where, you have to look at the statistics, and you have to look at where those crimes are happening. You have to look at where the changes are happening, and you make strategic choices on your property purchase based on that. I can see it on a more granular level because I'm actually driving the streets. I'm actually meeting the tenants. I'm actually seeing the transition from one property to the next, one neighborhood to the next. Where someone that looks up, St. Louis as a whole, they're going to probably pass it up because they don't see a lot of job growth. They see high crime. They see, that, they read the news and they see bad things. When someone from outside of St. Louis thinks about, ask them, oh, what do you know about St. Louis, Missouri? Oh, well, Cardinals baseball, Budweiser beer, and crime. So, that's not necessarily it. People think back to like Chevy Chase's summer vacation when they drive through St. Louis, and he actually parks and someone's trying to sell him something, and then they jack the car up and take the wheels off the car. I mean, that was
Right.
back in the 90s, or before, and it's not like that anymore. It's a much better community. I didn't live here then, but just like New York City's changed in the last 20, 30 years, St. Louis has changed in the last 20, 30 years. It's just a smaller place, and you have to know where you're buying.
Right. No, and I think that's kind of the thing that um, I see is that, when I think of a marketplace, and clearly, I grew up back in the Midwest, and Kansas City. It was the I think I've been to St. Louis maybe once or twice, but I remember there was, like, there were some neighborhoods to be aware of, kind of thing. But that was about all I could speak to. But I think all cities have an element of, um, whether you call it less desirable, or just there's a concentration of, and and that. I'm kind of curious. Can you speak to, or are you aware of, are you seeing any support from the local government to kind of affect this change? Is there any kind of incentives for investors, or is there are they attracting any new jobs? Or I mean, you mentioned some of these new technology companies coming in. Is there an effort to really um, attract these types of opportunities? And then
100%. It starts at the top. And in order, local governments do this all the time. They give credits, tax credits, or bonuses, or will offer um, some sort of bond or something like that for a new company to move jobs to their city. It's a common thing in St. Louis. Absolutely promotes that. They are great about recruiting new companies to add to their current workforce by offering them additional, tax credits, or so on and so forth. Or they'll offer free land to developers to develop office buildings in many cases, or subsidize that. There's tax credit opportunities um, for restoring historic properties. That's a very big help to the advancement of the neighborhoods that are not that are not as desirable. Of course, the federal tax plan for opportunity zones is a big effect on St. Louis, because a large swath of St. Louis is considered an opportunity zone. So those areas where a large scale development can be drastically changed over, because it requires the seller or the owner, the new buyer, to invest equal to the amount of the purchase price of the property into the property over the course of, I believe, the first 18 months of ownership. So let's say someone buys a $1 million apartment building. They have to invest $1 million into that apartment building in order to take advantage of the tax benefits of the opportunity zone. And many, if not most, of those sections of the city that I just described are considered opportunity zones. So that'll benefit the guys that are smaller, the guys that aren't full developers like myself. So if I own the apartment building next door to that one and it's getting a facelift, it helps benefit us all.
yeah, no, there's nothing wrong with being in the path of progress. That's a good place to be. Um, so you mentioned, and we've kind of talked about jobs and stuff, and you mentioned six figures. What is the median income of the areas you're investing in?
As a whole, last I remember checking, I want to say the median income in St. Louis is in the like 50-ish thousand range
Okay.
for the entire MSA. That's, I believe, off the top of my head, when I was looking at city data last, it was in the mid 50s, something along those lines.
All right. And then as far as housing supply, um, one of the things that at least having lived in a couple different areas, I mean, the Midwest that I've experienced has not really been restricted by any kind of physical, limitation as far as expanding, moving out and out. But it sounds like what I'm hearing you say is that the jobs and some of these new employees and the just the want to be closer in is kind of driving this gentrification, which to me would be kind of, there's a restricted area there. That's not like they're wanting to go 50 miles outside of the city. They're looking to go in, which is again kind of an area. And I'm assuming, is there a lot of new construction, or is it mostly gentrifying existing stock?
All of the above.
Okay.
So, one interesting thing about St. Louis is it is in essentially a U or a bell shaped, separated from the state of Illinois by the Mississippi River. And a lot of people who live and work in Missouri choose not to live in Illinois and would not cross over the river, because the state income taxes are quite a bit higher over there. The property taxes are as well. So there is a barrier there. So there's not a 360-degree expansion of the MSA it's only in this direction. They're only expanding to the west and the south. And the north is restricted as well because it is bordered by I believe up there it's the Missouri River, or the Illinois River. The reason why St. Louis exists is because of the intersection of the Missouri, the Illinois, and the Mississippi River. Um, so anyway, so that is it. It is landlocked, separated by the rivers that divide the state of Missouri and the state of Illinois. And yeah, so and there's an area of town where, like you described, is very crime ridden, and very few people would choose to live there if they could choose otherwise. And that is towards the northern section of town. So that area is receiving, there's like a barrier right there that stops people from wanting to live or move to that area. So the great, growth is in the south of downtown areas, or what we call South City. Those areas are experiencing the urban growth. The Central Corridor and the South City area are growing in population of higher net worth people or higher income earners. And then you have towards the west a further expansion into the what would have been more rural counties and suburbs of Jefferson County and St. Charles County and St. Louis County. That's where the new homes or new tract homes are going up all the time, and you have that. You just only have it in one direction, which is great for being able to see where the growth might be. And my newest acquisition that's under contract is in that direction. It's further out in Jefferson County, where I believe over the course of the next decade, there will be a lot of growth in population in that particular county, in that particular town, because the schools are good and you can get to work downtown in less than 30 minutes. So you just watch that path of progress. And once you figure out where it is, it's pretty easy you're able to discern where the growth will more than likely happen.
Got it. Is there a lot of new construction for multifamily properties?
There is. So in the Central Corridor and in the South City area of St. Louis, they are building a lot of new construction developments of apartment buildings and condos. They have to house these six-figure earners somewhere, and a lot of those six-figure earners the ones that are renting are choosing to rent apartments in newer apartment buildings. And there's a lot of new development going on where they'll tear down, a couple smaller 3-story tall buildings, let's say, and then come in and build a brand new construction 12-story tall, couple 100-unit apartment building with a parking garage and a pool and all the amenities that a six-figure earner millennial would want to have.
Right. No, and I think the more I talk with people that have kind of accepted or, come to the conclusion they like renting, there's not this sense of need to race out and buy a house in the suburbs and cut their grass on the weekends and all that kind of thing. So yeah, I think, we've talked a lot about kind of like the migration or the workers and stuff, but I'm kind of curious, can you speak at all to just the demand, in St. Louis specifically? Are you seeing, who are the people that are choosing to rent?
I see it as 3 different groups. So first of all, you have the person who wouldn't necessarily, the blue collar worker, working class person who lives paycheck to paycheck. Those people will always be renters. Those are the people that they've probably always rented, most likely. Or maybe they had an opportunity to own their own home for a period of time and then fell on bad times during the recession, and then, lost their home to foreclosure, and they'll probably never go out and buy another home again. And then you have the millennial person or the other, like the millennials and the baby boomers, who are decent earning people, who have good jobs and, like you said, don't feel the need to have 4-bedroom, 2.5-bathroom house with a 3-car garage in the suburbs with a white picket fence. Not a lot of people are deciding that, living in an urban environment and being able to walk to the coffee shop is perfectly reasonable. And that's where a lot of those $250,000 remodeled homes are selling to, are those people, or they're choosing to rent, and they'll choose to rent and they'll pay, you know, good rates for their rents in a neighborhood where you can walk to coffee shops and restaurants and pubs and yoga studios and, craft donut shops. Like it's great. It's really great for the urban suburbs of St. Louis, because they're seeing a lot of growth, and other cities too. This isn't just to St. Louis. You see the same thing in Cleveland and Indianapolis and all the other cities as well. It's just finding where those pockets are and trying to get ahead of the rest of the guys if possible.
Yeah, no, I think there's definitely a move for the lifestyle. Um, I've talked to more and more baby boomers that are downsizing. They're out of or everybody's out of the house. It's just one or two of them. Big house, a lot of maintenance, and sell that, move into an apartment, and happy they made the decision. Uh, they can lock the door and leave and don't worry about anything. So it's all
Yeah.
good.
Life isn't just about mowing grass every, Saturday or Sunday. It's not like my grandparents' age where everybody wanted to have the house in the suburbs. Now it's, instead of spending the time and money on that, it's spending time with your friends and family and doing activities. A lot of people now are focused on entertainment. Entertainment is a big portion of their budget. And where do you get the most entertainment? It's living in the areas, urban environment where you can walk or go to a movie really easily, or the symphony, or a baseball game, or any number of those things. And people will make living expense sacrifices and choose to live a less expensive lifestyle when it comes to their housing expense, or owning a large home. And they'll choose to rent, and then they'll choose to spend their time and money going out to dinner or going to the symphony or going to a baseball game.
Yeah. No, and I think it all starts with the jobs, though. I mean, if you've
Yeah,
got if there's good paying jobs, you can have a nice place, rent a nice place, and have the discretionary income to go out and enjoy all that. So it's, I think it's always important to pay attention to the jobs and be aware of that. Um, you mentioned doing a heavy lift. When you're looking for a property, are there any kind of things you look for as far as an opportunity goes?
absolutely. I look for properties where I can come in and spend money on strategic upgrades that will increase the rentability of the apartment, or the overall aesthetic feel, or the rental rate. So things like cabinets and vinyl flooring and a modern paint scheme and brush nickel hardware and a modern floor plan, with an open kitchen, living, dining space, all improve the rentability. Large closets, that helps a lot as well. Those all add to the rentability of the apartment and will increase the overall demand for the apartment and increase your rental rates. Of course, you have to look at the other comparable rentals in the community and see what other people are offering and other people are doing. But one with newly painted gray walls, white cabinets, and all new vinyl flooring throughout, that will demand a slightly higher rent than the other comparables in the neighborhood. And I look for a property that has 20% or higher increase in rent ability. So if I'm buying it for, let's put a round number of $1,000 a month, then I want to be able to know that after I go in and improve the common area spaces as well as the apartment, that I can rent that apartment for $1,200 or more per month.
No, I appreciate that. That's kind of some, easy to think of things when you're out looking, kind of running your numbers and and having some sort of a benchmark that makes, gives you a tell, if you will, that says, hey, look, this is worth digging into. I think those are always good to have. Do you have any advice for investors looking to get started in their local market?
Absolutely. I'm a big believer in the power partnerships, especially in this larger scale size business of multifamily. It's a lot easier to get a lot more done when you have, at least one, if not two or three partners that all rely on each other to be able to execute the business plan. Because this is a business. It's not, just an investment. It's not just a onesie twosie house or whatever. This is a business. They're each property has its own business plan, and when I can rely on someone else to help me take action items off of my to-do list, frees me up to be able to do things that I'm more productive at. Things like finding the next property, making sure that each unit is turned over properly, interviewing new subcontractors, renegotiating the contracts that we put onto places. So the power partnerships is invaluable. I see very few people that can really grow this thing on their own. And if they do, or they're able to, it takes them decades. It takes 2 or 3 decades to accumulate, 2 or 300 doors. And you can now, with the power partnerships, I have partners across the country. My primary partner is in California. And then I have partners in Minneapolis, and I have partners in Hawaii, and I have partners in Pennsylvania, and they all help me make sure to execute the business plan. I just happen to be the guy that is the only one here in St. Louis.
No, I think you're spot on. It's one thing to say I'm going to do it myself, but the rate of accomplishment is going to be limited by your capital, and I think the thing that um, is really woken myself up to the need to partner is just when you consider that real estate's a leverage play. I mean, really, what you're trying to do is get into the biggest number you can, and that leverage, as the whole number increases in value, then your percentage of that will increase as well, as opposed to getting into the smallest thing you can and only having a smaller number, and the percentage of that smaller number is still going to be a lower number than the percentage of the bigger number. So
And it opens up your ability to further diversify your portfolio. So, for example, Portland, if you were the only guy on your team, you would probably have a difficult time purchasing, evaluating, and finding properties outside of Portland. But if you found a partner in Atlanta, that now opens you up to opportunities in Atlanta. Or your New York partner you could open up opportunities to a New York partner in Portland. So yeah, especially now that the ability to do video chat and internet and send emails back and forth and execute contracts electronically and wire funds within hours and have it be across the country in hours. It's so much easier to partner and find people that are that are strong, and finding a partner that complements your strengths, or offsets your weaknesses is absolutely key. So having a partner that, let's say you are the boots on the ground guy, who has experience in property management, well, where are you probably going to need the most assistance? Well, capital, raising capital and bringing capital to the table, maybe net worth, or bookkeeping or something like that. That's where I get a lot from my partners, is bookkeeping and capital raising. And then I focus my time a lot on finding the deals and executing the business plan.
yeah, nope. There's definitely power in the partnerships there, and couldn't agree more. Hey, Lee, if we could, like to shift gears here a second. As I mentioned to you before, and we've talked a little bit about, by day, I'm an insurance broker. And as an insurance broker, I work with clients to assess risk and determine what we can do about the risk. Um, when we're trying to manage risk, there's typically three strategies we consider. The first is, can we avoid the risk? The second is, can we minimize the risk? And if neither of those are an option, then we look to see if we can transfer the risk, and that's what an insurance policy is. And so I've been asking all of my guests, and I'd like to ask you, if you're willing, if you can consider what the biggest risk is. And just to be clear, I'm not necessarily looking for an insurance related answer. Um, so with that, if you're willing,
Yeah.
Lee Fjord, what is the biggest risk?
I would say the biggest risk in our business, in this business of commercial multifamily, is interest rate risk. I think right now we are at a wonderful place in time and economy with respect to our ability to get low interest rate loans with very high value to purchase or low down payment purchase properties at low interest rates. And I think that cap rates and the valuation of commercial property is directly associated with those. So if if interest rates rise to 8-10%, then which they have been in the past before, then and your loan comes due, then the cap rate on your property is going to increase, which is going to decrease the value of your property, and you're going to be in a hard place. So I try to mitigate that by first of all, as quickly as possible, I try to return the initial investment back to all the investors, first of all. And then whether it be through cash flow distributions or refinancing the property. So that removes their initial investment into the property. And after that, everything should be considered, returns. So after that, so that's my number one goal. So I try to remove the risk by removing their initial, capital from the deal. Then we try to refinance our deals into long-term debt options, 10 years if possible, or longer, um, at the lowest possible interest rate, of course. And then you can offset that risk by either having a higher down payment or loan to value ratio, so you can take out loans and as opposed to 15% or 85% loan to value, you can do 75% loan to value, leave a little bit more money on the table. And those are really and then also, I guess the last and final option for that you can remove risk is by putting your properties under non-recourse debt. So then you're removing the potential risk of having any other assets that you as an owner or a partner or an investor on a deal, for potential loss if the property were to at one point in time be faced with needing to be repositioned or refinanced during the worst of times. Then at the end of the day, the worst thing that can happen to you at that point, if it's a non-recourse property or non-recourse debt, is the bank will take the property from you. They can't seize your personal income. They can't seize your personal home. They can't go after your retirement accounts. So that's our goal. Our goal is to return the initial investment back to our partners and investors as quickly as possible and refinance into a long-term debt solution at the lowest possible interest rate that is a non-recourse loan.
No, it sounds like a good strategy. Like I said, interest rate is definitely something that makes the real estate world go round, and all sorts of things can happen when it changes. So, appreciate you taking us through that. Lee, where can the listeners go if they'd like to learn more or connect with you?
Absolutely. I love when listeners reach out to me directly. I'm happy to give my direct phone number out to anyone. So my phone number is 850-797-1307. They can email me at Lee, Lee, period, Fjord, lee.jord@gmail.com, or they can find me on Instagram, lee.fjord. And I'm also on Facebook, LinkedIn, but Instagram, direct phone calls and emails are going to be the best way to reach me. And if I don't have an answer, just shoot me a text and I'll call you back as soon as possible.
Awesome. Hey, Lee, I can't say thanks enough for taking the time. I've enjoyed it, learned a lot, and hope we can do it again soon.
Same, Darren. I really appreciate your time and your listeners' time as well. Have a great day.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.